There comes a point when it becomes completely unsustainable. So something has to be done to at least put the debt in check or reduce it or slow down. And I think one of the options, and by the way, this is not the only option, Daniela, but I think it's a very attractive one for the United States, would be to revalue gold at a higher level than the statutory price. The gold certificates are effectively perpetual instruments, a bit like a banknote. They're perpetual, they're zero coupon, the government pays no interest on these gold certificates, and they can't be redeemed by the Federal Reserve, not for gold, not for cash, not for anything, unless the Treasury says so. So that would help a little bit if they did it at the current price of $3,300. But what I suggested was perhaps they should choose a different number, and I suggested the right number might be $15,000 an ounce.
The U.S. national debt has entered a stage that many economists now describe as completely unsustainable. With annual deficits exceeding $2 trillion and interest payments alone consuming nearly 1/5 of federal tax receipts, the Treasury faces a fiscal trap. 3 years ago, only 8% of tax revenues went to service the debt. Today, that figure has more than doubled to 18.6%. The Congressional Budget Office projects this burden will keep climbing as nearly $9 trillion of low-yield debt matures over the next 5 years and must be rolled over at much higher rates, closer to 5%. At some point, Washington will be forced to act. Clive Thompson, a highly respected analyst in the gold markets, has put forward one of the most radical yet historically proven options available to policymakers: a revaluation of America's gold reserves. Officially, the U.S. still carries its gold on the books at $42.22 per ounce, a figure frozen since the early 1970s. That means the Treasury's 261 million ounces of gold, worth nearly $900 billion at today's spot price, is being reported as an asset worth less than $11 billion. Thompson argues that correcting this imbalance by revaluing gold to market levels or higher could provide the U.S. Treasury with an immediate windfall in the trillions of dollars without technically increasing the national debt. The mechanics are simple but powerful. The Federal Reserve holds gold certificates. By revaluing gold to its current market price of around $3,300 per ounce, those certificates would suddenly be worth hundreds of billions more, effectively transferring $700 billion or more to the Treasury's balance sheet. But Thompson takes the idea much further. He argues that $3,300 is not enough, and suggests that a fair price for gold should be set closer to $15,000 per ounce, a revaluation that would release nearly $4 trillion in fresh capital to Washington's coffers. And here's where the story gets even more interesting. Thompson believes that such a dramatic revaluation would not only reset the U.S. financial system, but also ignite a historic move in silver. If gold is revalued and the Treasury stands ready to buy at $15,000, the flood of cash created would spill into other undervalued assets, silver chief among them. The much smaller silver market would be overwhelmed, potentially accelerating its price as much or even more than gold's. Stick with me, because in this video, we're going to unpack Clive Thompson's analysis in detail, hear from him directly, and explore what revaluing gold really means for investors today. Before we dive into his full breakdown, make sure you like this video, subscribe, and turn on notifications so you don't miss important market signals and expert analysis. Thanks, and enjoy the video.
So let's start with the price. Obviously, 15,000 was a number which I thought would be appropriate, but I've seen many arguments both for higher numbers and lower numbers, and I'll discuss how I got to a 15,000 level. But
Yes.
let's just go back a step and look at why it could be very beneficial to the United States to revalue gold. The United States is running record budget deficits. The debt is rising rapidly, and it is likely that the interest to be paid on that debt is going to rise very fast from here. We've seen the interest expense as a percentage of the receipts, the government receipts, i.e. the taxes it's taking in, rise from 3 years ago, just 8%, In other words, they were taking in taxes of, let's call it taxes of 100 and paying 8% in interest, and the rest was used for other government purposes, to this year 18.6%. So it's more than doubled, certainly more than doubled in 3 years. Now, according to not only my calculations, but the Congressional Budget Office's calculations,
Yes.
that number is going to continue to rise for the foreseeable future. The only comment I'll make is the CBO is almost certainly being too conservative in their numbers, because they are assuming an interest rate which is unobtainable, i.e. far too low, unobtainable if you're a borrower at the moment. So the government has a large amount of debt maturing in the next 4 or 5 years. I think it's something like 9 trillion, which a lot of that debt was taken out when interest rates were 1 to 2%. And they're going to have to roll it over at higher rates, which are closer to, I'm going to say closer to 5%, although 4.2% wouldn't be an unreasonable rate at the moment. That will cause the amount of interest being paid on the national debt as a percentage of the tax take to be actually worse than this 22.6% that the Congressional Budget Office sees for the year after next. And it's going to spiral up quite a rapid pace beyond that. And there comes a point when it becomes completely unsustainable. So something has to be done to at least put the debt in check or reduce it or slow down. And I think one of the options, and by the way, this is not the only option, Daniela, but I think it's a very attractive one for the United States, would be to revalue gold at a higher level than the statutory price. Now, the statutory price for gold was set in, I think, originally was set when they raised it from $25 to $35 in 1934. And then I think they raised it again in 1972 and 1973 to now $42.22 an ounce. So the gold that the United States holds is on their books at a price of $42.22. And the Federal Reserve, who does not own the gold, but has a gold note representing the gold they did sell to the Treasury, a gold note which is worth $11 billion, priced at the original price of $42.22. Now, that gold note or gold certificate is not convertible into gold by the Federal Reserve. It just represents legal tender of $11 billion, even though it's called a gold certificate. Meanwhile, the Treasury's got the gold, which they've got on their books at $11 billion, but it's really worth, if we take a market price, today's market price, I think it's somewhere between 3,300 and 3,400 as we're doing this show, might be a little bit higher in a few days. That would release $750 billion, and I'll explain how if they were to revalue it. Now, there's several ways in which this can be done. And I'm also going to get to why 3,300, 3,400 is not the right number, why a higher number would be the appropriate one, the 15,000, which I talked about. But I just start with the basic principle that they go to the current market price of gold, and then we'll go from there as to why the higher number will be better.
Sounds good.
So there's broadly speaking, two ways in which this can be done. The first one was outlined in the Bitcoin bill, Bitcoin Act, which hasn't passed into law, but basically that act specified as a subclause of the act, the Federal Reserve would tender its gold certificates of $11 billion to the United States, in other words, to the Treasury. The Treasury would then immediately revalue gold to the current price. In that Bitcoin Act, they referred to $3,300. And then the Treasury would reissue to the Federal Reserve gold certificates identical to the previous ones, but at the current market value, which would be $700 or $800 billion. And the Federal Reserve would be obliged, on that happening, to pay to the Treasury the difference between the value of the two gold certificates, in other words, a bit more than $700 billion. Now, the beauty of this, and by the way, this has already happened effectively in 1934 anyway, so it's just repetition of the same old trick, same old, same old. Now, the beauty of this is that the gold certificates are not part of the national debt. In other words, when you see the national debt, that includes bonds issued by the government, notes issued by the government, treasury bills issued by the government, but it does not include the gold certificates. So in swapping 11 billion of gold certificates for 750 billion of gold certificates, the Federal
Right.
Reserve would have to pay to the Treasury the difference, $700 billion, without increasing the national debt. In fact, the Treasury gets the $700 billion, $750 billion, and it can use that money to reduce maturing debt, and obviously, because it's revalued the gold, it will show a huge profit, at least not as much to cover the budget deficit, which of 2 trillion, but it'll cover a third of the current year's deficit, bringing the deficit for the current year looking like it's not rising as fast as it really is. The gold certificates are effectively perpetual instruments, a bit like a banknote. They're perpetual, they're zero coupon. The government pays no interest on these gold certificates, and they can't be redeemed by the Federal Reserve, not for gold, not for cash, not for anything, unless the Treasury says so. So that would help a little bit if they did it at the current price of $3,300.
The urgency of Thompson's message cannot be overstated. If interest expense continues rising at this pace, the United States will be devoting a quarter or more of its tax receipts just to service debt within a few short years. Revaluing gold at the current market price could provide some relief, but Thompson's argument is that going higher, to $15,000 per ounce, would unlock far greater breathing room. That figure would effectively deliver nearly $4 trillion into the Treasury's hands, enough to cover 2 years of deficits and even show a temporary budget surplus. Still, Thompson injects an important dose of caution. While some gold advocates argue for extreme revaluations, even $150,000 per ounce to wipe out the entire U.S. debt, he warns that such a move would destabilize global markets and risk uncharted consequences. His proposed $15,000 figure is aggressive, but also measured, large enough to materially change America's fiscal outlook, but not so large that it would shock the system.
Suggested was perhaps they should choose a different number, and I suggested the right number might be $15,000 an ounce.
And I know the question you were getting was, because that would pay off 3.9 trillion, right? So why not higher? Why couldn't they go higher and pay off more of the debt?
Well, exactly. A lot of people are saying, well, why not revalue gold at $150,000 an ounce and pay off the entire national debt? I think that's a dangerous strategy, because it's going out a little bit too far into very untested territory. The figure I proposed of $15,000 would generate cash for the Treasury of 3.9 trillion. Now, that's not a terribly big number of cash relative to the national debt of 37 trillion. It's about 10% of the national debt. And it's not a terribly big number relative to the amount of increase in debt they have every year, which is around 2 trillion, slightly more. So it's a little bit adventurous. But the market can absorb that extra 3.9 trillion with no problem at all. I mean, after all, 3.9 trillion is smaller than the size of Microsoft. It's smaller than the size of Nvidia. It's smaller than the size of several companies on Wall Street. So that would be 3.9 trillion of new cash coming into the Treasury's hands, which would allow the Treasury the ability to retire some of the debt which is maturing this year and next year, and show not a deficit for the current year, because the deficit is going to be 2 trillion roughly, but it will show a profit of 1.9 trillion on its budget for the current year. And it would bring the debt down to the level of where it was a year or two ago as well. Now, of course, this is only temporary respite. It's not a permanent solution. It's kicking the can down the road.
Correct. And again, we're just playing out this scenario. I mean, is part of the reason you also think this could happen is because Scott Bessent is a gold bug and people in the administration are pro-gold? Does that add into your equation here?
Well, we've seen the Oval Office decorated with all kinds of golden things these days. But the reason for thinking this might happen was the original comment a few days after Scott Bessent became Secretary of the Treasury, in which he
Yes.
said, we plan to monetize the US balance sheet for the benefit of the American people. Now, the one liquid and undervalued asset they've got, or the most undervalued, most liquid asset they've got, is the gold. So it's a reasonable assumption that at the time he said that, he was thinking of the US government's gold.
Now, again, let's play out the 15,000 scenario. People are going to say, well, then who would buy my gold?
Exactly. Well, the brilliant thing here is if the Treasury does this, to make it plausible, they should stand buyer of last resort of all the gold that's coming to them at $15,000 an ounce. Now, that would be a brilliant move by the Treasury because, one, it's going to get a lot of gold that it wants in exchange for worthless paper, which you can print ad infinitum, via the Federal Reserve by just repeating the trick over and over again. So it's going to get a lot of gold onto its books. It's going to mess up America's enemies, if you say, and I don't mean enemies in the bad way. I mean the sort of financial enemies, the ones who are saying, we want to convert our Treasury bonds, our Treasury bills, because we don't really trust them. We want to convert them into gold. And we see that ongoing a little bit here and there, and it could turn into a rush. But if they push the price of gold that much higher, it's going to become that much more difficult or that much more expensive for those foreign holders of Treasury bonds and bills to convert them into gold, or at least to get as much gold as they were getting at the old price. So in a way, it's mess with your enemies a little bit by putting the gold price at $15,000.
I guess my other question is, if that scenario plays out, we know the administration wants a lower dollar. They've been vocal about it, but would it cause a dollar collapse?
No, I don't. I mean, the dollar will go down a little bit, but I don't think so. I mean, obviously it did in 1934 when they pushed up the price of gold by 69% in one day, and that caused effectively the dollar to be 51%, 51% lower. I haven't got the exact figure, but in other words, the rate of the amount of pounds, euro, well, it wasn't euros back then. It was the amount of pounds or Swiss francs or French francs that you could buy back then changed overnight, rather upsetting all the bankers in Europe who suddenly found that their dollars were worth that much less. But I don't think that's going to happen in the same way today, because the world currencies are not linked to gold. So back then, the French franc and the British pound, all these other currencies were linked to gold. So when you reduce the amount of gold and dollar, the dollar's worth less. But today, all the currencies are linked to the dollar anyway. So not on a peg basis, but the dollar would go down a little bit. It wouldn't make a big difference. And it certainly would not change retail prices, as a lot of people suggested. Some people have said, wow, this would be terribly inflationary. Well, no, there's no way it's going to cause any inflation at the retail price level, because although there'll be more money coming into the system,
Right.
that money's going into the hands of the Treasury at the first instance. And all it's doing, as far as the Treasury is concerned, is not forcing them to borrow more money. So the money supply at the end of the day is going to stay fairly constant as the Federal Reserve and the Treasury manage the national debt between them. So the money supply isn't going to shoot up. And even if the money supply was going to shoot up, where's that money going to go to? It's going to go to financial assets. It's not going to go to the price of pizza. It didn't.
Well-
If we go back into 1934, in America, the price of nothing changed because of this. The anticipation of what was going to happen changed the stock market price, but didn't change. It didn't change the cost of goods in the shops, and it won't change the price of goods in the shops again this time, because prices of goods in the shops are not linked to the gold; they're linked to paper money, and that's not going to change.
What makes Clive Thompson's analysis so powerful is how it aligns with the warnings of other heavyweight thinkers like Jim Rickards and Andy Schectman. Rickards has long argued that a reset of the monetary system will require a gold price north of $27,000, while Schectman has pointed out that central banks around the world are already preparing for this reality by aggressively accumulating physical gold. Sheckman believes in an endgame scenario where the fiat monetary system completely collapses. Thompson adds to this chorus by quantifying how a U.S. revaluation could be executed quickly, efficiently, and without even adding to the debt. But perhaps his most compelling point is about silver. If the Treasury declares itself the buyer of last resort for gold at $15,000, countless private holders will sell into that bid. The cash they receive will not sit idle. It will move into other undervalued hard assets. And with silver's tiny market compared to gold, that influx of capital could ignite a surge unlike anything we've seen before. Thompson himself admits that silver could outperform gold in percentage terms during such a revaluation, making it one of the most asymmetric opportunities of this decade. Whether or not Washington has the courage to take this path remains to be seen, but the math is undeniable. The debt is unsustainable, interest costs are spiraling, and gold is the one undervalued liquid asset sitting quietly on the government's balance sheet. Investors who understand what's at stake and position accordingly could be on the right side of a generational shift in monetary history. If you found this breakdown valuable, make sure to hit the like button, subscribe to the channel, and share this video with fellow investors who need to hear it. Thanks for watching, and see you in the next one.